Hello and welcome. My name is Partho Majumdar. In this video, we will discuss how we can square our positions when we trade in options. Now, a brief idea about what is an option. Option, we know there can be of two type of options. One we call the call option and one we call the put option. Now, in an option, we do not trade on the security directly. However, we use the security as an underlier. So the security could be a stock or a bond or a commodity, or it could be a currency, etc. So we do not actually hold the security, we do not hold the stock, or we do not hold the bond or the commodity. However, we trade on that, and as a result of the trade, whatever the proceeds come, whether it's a profit or a loss, we take that. So that's what is the option. Now, in an option, we know that we can make a profit or we can make a loss. This video is about how we can minimize our loss in a situation where we are running into a loss while trading in an option, how we can minimize the loss, and we will see how we can actually make a profit from a situation where we could run into a loss. So before we proceed further, let us quickly recall what is the call option, and subsequently we'll discuss the put option. First, we'll discuss the call option. So a call option is used by a buyer when he wants to buy an underlier. So the call option is used when a buyer wants to buy an underlier. The underlier could be a stock or a bond or a commodity or currency, and the buyer will buy a call option when he expects the price of the underlier to rise. So this is important. When he expects the price of the underlier to rise, that's when the buyer will buy a call option. Now, in a call option, let's take an example. Supposing I enter into a contract in a call option where I say my strike price is $102 and I'm ready to pay a premium of $2 and an expiry of 1 month, and I buy a lot of 100 quantities. So these are the important things which are necessary in a call option, that we must have a strike price, a price at which we will buy the call option. So here is the strike price, and we pay a premium. So this is the premium of $2 that we are paying, and we say that this option will expire in 1 month. So if the price of the underlier goes up, then we make a profit. At this point, we break even, and if it further rises up, we make a profit. The profit that we make from a call option can be unlimited for the buyer. However, if the price does not go up and instead the price goes down, then the loss that the buyer will incur will be minimum. That is the extent of the premium what is agreed between the buyer and the seller. The buyer will suffer a loss. So in this call option, we have unlimited profit for the buyer possible, and we have a limited amount of loss possible for the buyer. Now, in a call option, the buyer will always exercise the call option when the market price is above the strike price. So this is the region. If the market price is above the strike price, that is all of this region, the buyer will exercise the call option. So between this point, from the purchase price to the break-even point, the buyer will still suffer a loss. After the price rises above the break-even point, the buyer will start making a profit. Now the reverse is true for the seller of a call option. Now, in a call option, we require a buyer and a seller. It's basically a financial contract between a buyer and a seller. So we just saw the buyer story in the previous slide. Now let's see the seller story. So the buyer will buy a call option when he expects the price of the underlier to rise, and the seller will expect that the price of the underlier does not rise. Now, in the case of a seller, if the price of the underlier rises, the loss of the seller will keep on increasing. So, as the price of the underlier keeps rising, the loss of the seller will keep on increasing. However, if the price of the underlier falls, the seller will have a fixed amount of profit. That is, the maximum profit the seller can get is the amount of the premium what was agreed in the contract. So for the seller, it's unlimited loss possible from a call option, but he can only make a limited amount of profit from the call option. So here we have put both the buyer and the seller story in one single chart. So here you see that this is the strike price at which the contract was made, and this was the premium agreed. That this is the premium agreed. So this is the same, and it has to have expiry and a quantity. The quantity, as we know, is always in some lots. So if you notice here, when the price rises and the price is in this area, the buyer will make a profit. So all of this area, the buyer makes a profit. And when the price falls, that is all of this area, the seller makes a profit, but the seller's profit is restricted to the amount of premium what is agreed in the contract. So another thing you notice is that the amount by which the buyer makes a profit, the same amount the seller makes a loss. Similarly, the amount by which a seller makes a profit, the same amount the buyer makes a loss. Now our problem is that we notice that when the buyer is buying a call option, he can make a loss. But the buyer's worst case is that the price falls below the strike price, and in that situation he will forego the uh, call option because it is a right of the buyer but not an obligation. So he does not have to buy if the price falls below the strike price. Now, under that circumstance, that's the worst case scenario where the price falls below the strike price. And in that circumstance, the buyer will not exercise the call option, and the amount of loss he will have, the maximum amount of loss that can be possible, is the amount of premium what is agreed between the buyer and the seller. Now, our need is that we need to find a way that we can reduce this loss which the buyer can suffer as a result of the price falling below the strike price, and we want to see whether we can still make a profit under these circumstances as well. So that is the problem which we will try to solve in this particular video. Now, in one solution what we can propose, there are many solutions to this problem. We will discuss only one solution in this video, and this solution what we are discussing is how we can square off the position. By squaring off the position, we mean that we at least do not suffer a loss, and if it is possible, we will try to make a profit. So what we will do is that one possibility is that the buyer has purchased a call option and he has made a premium for that. So this is the buyer's position when he makes a purchase of a call option. So like we discussed before, this is the strike price. At this strike price, he pays the premium. So this is his starting position. If the stock rises, he reaches a point which is the break-even point, that is here. And beyond that, if it rises, he has a profit. And this, as much as it rises, so much amount of profit the buyer will have. However, if the price falls below the strike price, the buyer will suffer a loss. So this is the area which we want to protect the buyer from. We want to either minimize it or we want to make a profit in this area as well. Now, the plan is that when a buyer buys a call option and he realizes that the price may fall, in that circumstance, what the buyer can do is he can sell a call option at a premium which is higher than the premium which he paid for buying the call option. So this is one call option which the buyer has purchased. Now he can sell a call option at a premium which is higher than the premium which he paid for buying the call option. So suppose the strike price was agreed as $102, that is here, and the premium what is agreed for purchasing the call option is $2, and the expiry is 1 month and quantity is 100. So this is the buy position of the buyer of a call option. What the buyer can do is that he can also sell a call option at the same strike price of $102, but here he makes a premium of $3. So this premium, this is going to be larger than this premium what he has paid. And the remaining things remain the same. It can be expiry of 1 month and he can make the same quantity of purchase. If this is the scenario, in this scenario, let's see what can happen. Now suppose this is the strike price, and at this strike price, the market value actually goes down, and the market value is somewhere here. Let me put it in a different color. The market price is at $101, where the strike price is $102. So under this circumstance, let us see the calculations. So if the market price is $101, the same will apply if the market price is anything less than the strike price. So since the market value is less than the strike price, for the call option which the buyer has purchased, he will not exercise the call option. Instead, he will pay the premium and come out of the position. So under that circumstance, his loss will be the premium $2 into the quantity 100, that is $200 will be his loss. That is, he has lost the premium as he did not exercise the call option. Now, he has sold the call option also at $3 premium. Now, if the market value is less than the strike price, the buyer of that call option, which this buyer has sold, he will also not exercise his call option. Under that circumstance, the premium of this particular call option, that is $3, will come to this buyer. So when this premium of $3 comes to this buyer, he will make a net profit of $300 on this call option which he has sold to another buyer. So net position of the buyer will be that he makes a profit of $300 and he makes a loss of $200, so he gains $100. So he has a profit of $100. So this is the circumstance when the market value falls below the call option. So we see that when the market value falls below the strike price, the buyer is making a profit. Now let's see what happens when the market price goes above the strike price. Let's take a situation where the market price is at $105. So when the market price is greater than the strike price, the buyer of the call option will exercise his call option. So when he exercises his call option, he makes a profit because he 105 minus the strike price of 102 minus the $2 which he paid as a premium. So he makes a profit of $1 per unit, and he has 100 units, so he makes a profit of $100 by exercising the call option. Now, for the sale of the call option which this buyer has made, his corresponding buyer, he will also make a exercise of the call option because he is at a profit at $105. So when he exercises that, in this case, this buyer will suffer a loss. Let me say the buyer, this is A, who has this call option which he has purchased, that is this one, and then he makes a sale of a call option. So A, first he buys and then he sells a call option to B. So when B exercises the call option, he makes the A makes a loss, which is $102, which is the strike price, minus the current market value $105, and plus the $3, which is the premium he will get from the buyer. Under this circumstance, it works out that there is no profit, no loss because it's zero. So the net position of the buyer A is that he has made a profit of $100 and a loss of $0. So his net position is that he has $100 profit. Let's take a third and a last case because that will be sufficient. Supposing the market price goes to $109 somewhere here. So supposing we are somewhere here. In this circumstance, again, A will exercise the call option because the market value is greater than the strike price. And after exercising the call option, he will get a profit because 109 minus 102 is 7 minus the premium what he has paid, that is $2. So 7 minus 2 is 5. So he makes a $5 profit for each unit, and he has 100 units, so he makes a profit of $500. So from this purchase of the call option which A has made, he makes a profit of $500. Now, since the market price is greater than the strike price, B, who has purchased the call option from A, will also exercise his call option. So when B exercises call option, he will also make a profit. When he makes a profit, A being the seller will make a loss. The amount of loss he will make is that his strike price is 102, the market price is 109, that is -7, plus the $3, that is, this is the premium what is agreed in this sale between A and B, plus $3. It means that A will suffer a loss of $4 for every unit. And since he has got 100 units, so the total loss will be of $400. Now, when we see the position, he has made a profit of $500 and he's made a loss of $400. So his net position is that he makes a profit of $100. So notice that in each of the cases, the profit is the same, $100. So by using this strategy, what A has basically done is that he has ensured a situation that where he at least makes a $100 profit and exactly $100 profit only, because this is going to be constant. This will not change, and no matter what the market value of the underlier changes to. Now let us discuss put option. So we know that we use a put option, we buy a put option when we want to sell a underlier. Again, the underlier we have discussed can be anything like a stock or a bond or a commodity, etc. Now, put option is utilized when we expect the price of the underlier to fall. So this is important that we expect the price of the underlier to fall. So in this put option also, we will buy at a strike price and we will pay a premium and we will have expiry for a particular period and we will buy certain lots of the underlier. So here we are making a strike price of 6,900, a premium of 50 rupees, and expiry is 1 month, and we are buying 1,000 units. So here, this is the strike price. So the strike price plus the premium, this is the amount of investment what we have made. So if the price of the underlier falls, then our profits start coming in. So at this point, when the market price is 50 rupees below the strike price, 50 rupees being our premium, then we break even. If the price falls further below this point also, that is it goes below, then we start making a profit. So this is the position of the buyer. So you notice that the buyer can make an unlimited amount of profit. However, if the price rises, then the buyer will not exercise the put option, and so his loss will be restricted to the amount of the premium because he will forego the premium. So here he has a limited amount of loss, that is from a buyer's perspective, but he has an unlimited amount of profit from a buyer's perspective. So this is the position of a buyer. Let us see what is the position of a seller in this case. In the case of a seller, the seller will make a profit if the price rises. But if the price falls, the seller will continue to have a loss. So as the price falls, the seller will suffer a loss, and this loss can be unlimited for the seller. However, if the price rises, the buyer will not exercise the put option, and so the seller will get the premium amount. So this premium amount becomes a profit for the seller, and the seller's profit is restricted to the amount of premium what is agreed in this particular trade. So he will have a limited amount of profit. The seller will have a limited amount of profit, but he can have unlimited amount of loss. So if now we put the buyer and the seller's position on the same chart. So we see that this is the strike price. This is the strike price, and this is the premium which the buyer has paid. So if the price goes below the strike price, the premium will go to the seller, so he will make a profit. So and this profit will be equal to the premium amount only. And this is the point where the break even happens for the buyer and the seller. That is, till this point of time, from here to here, the buyer is actually suffering a loss, and from here to here, the seller is still making a profit. But beyond this point, the seller starts making a loss and the buyer starts making a profit. Similar to the call option position situation, we have a situation where we want to minimize the loss which can happen to the buyer. And we would want to see whether we can make a profit from this scenario. So here again, we have a strategy similar to the call option. So here what the buyer has done is he has bought a put option. So let's call our buyer is A. So A buys a put option. So this is the purchase what A has made at a strike price of 6,900, premium of 50 rupees, expiry 1 month and 1000 units. Now to protect himself against the loss, he sees that the the price of the commodity may not fall. Under that circumstance, what he can do is that he can find another buyer B, and to B, A can sell a put option which is like this. So here what he will do is that he will keep the strike price the same, but he will make the premium more than the premium what he has paid to buy the put option himself. So he will make a premium which is higher and keep the other terms and conditions the same. So here what happens is that in case the market price is greater than the strike price. So here we have the strike price, and if the market price is greater than the strike price, let's take that the market price is 7,000 rupees where the strike price is 6,900. Under that circumstance, the buyer will not exercise the put option. So when he does not exercise the put option, he will have a loss, and the loss will be equal to the amount of the premium what is agreed between the buyer and the seller. So in this case, he will suffer a loss of 50,000 rupees by not exercising the put option. However, A has sold a put option to B, and from that put option, he will have a profit because B will also not exercise the put option because the market price is greater than the strike price. The market price is here, whereas the strike price is here. So since he does not exercise, the premium what is agreed between A and B, that A will get, that is rupees 100 into the number of units. So he will make a profit of 100,000 rupees. So net position of A is that he made a profit of 100,000 and made a loss of 50,000. So his net position is he will make a profit of 50,000 rupees. This is a situation when the market price goes above the strike price in a put option. Now suppose the market price falls below the strike price. Under that circumstance, A will start making a profit from this particular put option which he has purchased. Suppose the market price is 6,800, that is here. Under this circumstance, A will make a profit where it is 6,900, that is the strike price, minus 6,800, minus the amount of premium what he has paid. So his net profit will be 50 rupees per unit, or a profit of 50,000 rupees. Under this circumstance, when the price is here, B, who has purchased a put option from A, will also exercise his put option because the price has fallen. And when when B exercises a put option, A will suffer a loss. So loss will be, that is 6,800. This is the market price minus 6,900 strike price, and B gets, and A gets from B the premium of 100 rupees. So this will be added to A's amount, and this means that A will have a net position of 0 rupees per unit. So he does not get anything from this particular trade where B is selling his put option. So net position of A is that he made a profit of 50,000. He didn't suffer a loss from the sale by B, and as a result, his net profit is 50,000 rupees. Suppose another circumstance where the price has further fallen and it has come to 6,600. In this circumstance, again, since this is less than the strike price, A will exercise his put option. So by exercising put option, he will have a profit which is equal to 6,900 minus 6,600 minus the premium what he has paid of 50 rupees. So he has a net profit of 250 rupees per unit, or he makes a profit of 250,000 rupees. Since 6,600 is less than the strike price, B will also exercise the put option, and as a result, A will suffer a loss. A's loss will be the market value of 6,600 minus 6,900, which is the strike price, plus he will add his premium what he will get from B. So his net position is that he loses 200 rupees per unit. So his net loss will be 200,000 rupees from the sale which B will make. Now the net position of A is that he made a profit of 250,000 rupees and had a loss of 200,000 rupees. So he made a profit ultimately of 50,000 rupees. So notice that by making this strategy, A has made that he always gets a equal amount of money no matter whether the market rises or falls. So he has a position where he will always make a profit, and that profit will be equivalent under all circumstances. So by squaring off, what a trader does is basically he ensures that he has a profit, but he cannot take advantage of the market in case the market is favorable to him. His profit is always restricted to a certain amount. So only when the trader becomes unsure that the market will be favorable to him and it can go in a reverse direction for him, then he will exercise the option of squaring off his position, either in a call situation or in a put situation. So that's all we have for this discussion. I hope you enjoyed it as much as I enjoyed bringing it to you. Thank you for listening.